Today, we're talking about investing, specifically for those of you who are just getting started. Investing can seem super intimidating at first. All these different asset classes, confusing terminology, and don't even get me started on taxes. But you don't need to be a Wall Street whiz kid or a millionaire to start investing. The earlier you start, the better off you'll be in the long run thanks to the power of compound interest. I'm breaking down 5 essential tips that'll set you on the right path to building wealth, regardless of how much money you're starting with. Before you even think about buying stocks, bonds, or real estate, you need to ask yourself this crucial question. Are you investing in the first place? What are you hoping to achieve with your money? Are you saving up for a down payment on a house, planning for early retirement? Maybe you just want to grow your wealth so you have more financial freedom and options in the future. It's like setting a destination on your GPS. You need to know where you're going before you can figure out the best route to get there, right? Without a clear goal, it's easy to get sidetracked, make impulsive decisions, or get discouraged when the market inevitably goes through its ups and downs. So, take some time to really think about your financial aspirations. Write them down. Make them specific, measurable, achievable, relevant, and time-bound. For example, instead of just saying I want to retire early, a smart goal would be, I want to retire by age 50 with $2 million in invested assets generating $80,000 per year in passive income. Once you've established your why, you can start developing an investment plan tailored to your specific needs and risk tolerance. Remember, investing isn't just about picking stocks, it's about aligning your money with your values and long-term goals. Alright, let's talk about diversification. This is Investing 101, folks. You've probably heard the saying, don't put all your eggs in one basket, right? Well, in the world of investing, this is the golden rule. Diversification essentially means spreading your money across different asset classes to reduce your overall risk. Think of it like this. You wouldn't want your entire net worth tied up in one single stock no matter how promising it seems, right? Because if that one company tanks, your portfolio takes a nosedive. Instead, you want to diversify your investments across different asset classes like stocks, bonds, real estate, and maybe even some alternative investments like gold or cryptocurrency if you're feeling adventurous. Each asset class has its own risk and return characteristics. By diversifying your portfolio, you're essentially hedging your bets. If one asset class isn't performing well, others might pick up the slack, helping to smooth out your overall returns over time. Think of it like building a well-rounded breakfast plate. Investing is the same way. A diversified portfolio is a well-fed portfolio. Let's talk about everyone's favorite topic, risk. The truth is, every investment comes with some level of risk. There's no such thing as a guaranteed return, and anyone who tells you otherwise is probably trying to sell you something. The level of risk you're comfortable taking will depend on several factors including your age, time horizon, financial goals, and overall risk tolerance. For example, a younger investor with a longer time horizon might be more comfortable taking on more risk because they have more time to recover from any potential losses. On the other hand, an older investor who's closer to retirement might prefer a more conservative approach, focusing on preserving their capital and generating income. Understanding your risk tolerance is crucial for making sound investment decisions. There's no shame in being risk-averse, just as there's nothing wrong with being comfortable with higher-risk investments. The important thing is to be honest with yourself about your risk tolerance and invest accordingly. Alright, let's talk about fees. Specifically, the pesky fees and expenses that can eat into your investment returns if you're not careful. Listen, I get it, no one likes paying fees. But when it comes to investing, they're unavoidable. The key is to be aware of the different types of fees out there and to choose investment options that minimize their impact on your returns. One of the most common fees you'll encounter is the expense ratio charged by mutual funds and exchange-traded funds, or ETFs. This fee covers the fund's operating expenses, such as administrative costs, marketing, and management fees. Expense ratios are typically expressed as a percentage of your assets, so a fund with a 1% expense ratio will cost you $10 for every $1,000 you have invested. While a few percentage points might not seem like a big deal, they can add up over time, especially as your portfolio grows. Another fee to watch out for is trading commissions. The good news is that many online brokerages have eliminated trading commissions altogether, making it more affordable than ever to invest in the stock market. Remember, every dollar you save on fees is a dollar that stays invested and working hard for you. Here's the thing about investing. It's not a set it and forget it kind of deal. The financial world is constantly evolving with new trends, technologies, and investment opportunities emerging all the time. That's why it's crucial to stay informed and keep learning throughout your investing journey. Don't worry, I'm not saying you need to become a financial expert overnight or spend hours every day poring over market data. There are tons of resources available to help you stay informed, from financial news websites and blogs to podcasts, books, and even YouTube channels like this one. By staying informed and continuously learning, you'll be better equipped to make informed investment decisions, adapt to changing market conditions, and ultimately achieve your financial goals. Plus, it's kind of fun becoming the go-to finance person in your friend group. Trust me on that one. That's it for my 5 essential tips for first-time investors. Remember, investing doesn't have to be complicated or intimidating. By starting early, setting clear goals, diversifying your investments, understanding your risk tolerance, keeping an eye on fees, and continuously learning, you'll be well on your way to building a brighter financial future. If you found these tips helpful, hit that like button and subscribe to the channel for more videos on personal finance, investing, and building wealth. Thanks for watching, and remember, the best time to start investing was yesterday. The second best time is today. Now go make that money.